Hi, and thank you for joining us. We're having so much fun demystifying what tax governance means for your business. My name is Louis Carney. I'm an indirect tax specialist here at RSM in Brisbane, and I'm joined by Michael Kaleneva, specialist from our corporate tax division. Now, Mike, can you give us a quick recap of our journey so far?
Good plan, Louis. If you're joining us for the first time today, special welcome. We encourage you also to look at our previous 6 episodes. In these episodes, we discuss tax governance more holistically and cover topics like the concept of justified trust, the ATO's review programs, what the ratings mean to your business, and the relevant guidance published by the ATO. Our initial focus is on the 7 principles of effective tax governance. These principles are relevant for privately held groups and inform part of the ATO's assurance programs for the top 500, next 5,000 and emerging groups. Today's segment is short and sharp and is focused on Principle 3, seeking advice. Louis, what key aspects of seeking advice have you seen?
Thanks, Mike. The ATO wants to see that clearly defined processes are in place for escalating tax issues and seeking tax advice. This includes engaging your tax advisor for complex or out of the ordinary transactions, referring to published ATO guidance, and if required, engaging with the ATO at an early stage for a private ruling. Now, we recommend that a documented process should consider the following to meet the best practice guidance. Explain the clear escalation thresholds, which could include quantitative and qualitative factors for when and how to seek external advice in a consistent way. Inform advisors of significant changes or atypical transactions. Ensure facts and assumptions that the advice is based on is accurate, complete, and not superseded. Consider ATO published guidance and advice and explain the clear thresholds for when and how to engage with the ATO and where pre-lodgement positions are agreed to lodge according to that agreed position. To highlight the importance the ATO places on seeking advice, an article was recently released on June 3rd identifying 5 tips to correctly report on significant transactions. 3 of these focused on identifying what a significant transaction is for the group and maintaining appropriate records, while the remaining 2 were to seek independent valuations to support sales between related parties and communicate significant transactions to your tax agents and advisors in a timely way, i.e. preferably when the transaction is in its infancy rather than post-completion. This further drives home how topical this area is and will continue to be for the ATO. Mike, how have you seen this principle play out in practice?
Thanks, Louis. I have a great example. I have a client that's a manufacturing business with a turnover around $60 million who's looking to acquire a second factory. Clearly, buying a new factory is not business as usual and is a significant and extraordinary transaction for them. Thankfully, for this client, they had a documented and endorsed policy from the board, which requires external advice to be obtained on this transaction since it's not business as usual. The client engaged us and we provided tax advice covering income tax, capital gains tax, GST, in line with the relevant cases and ATO guidance. When the ATO invariably comes knocking, we will be able to evidence that this client had effective tax governance for this principle by providing a copy of our engagement letter and the final advice. Since the ATO reviews operate on the basis that the client has to show actual evidence that it has sought advice and followed its own processes around escalating the tax issue, this will hold the client in good stead for any justified trust review. We look forward to bringing you the next episode soon, that is Principle 4, Integrity in Reporting.
Thank you and have a great week.
Thank you.